Welcome to this afternoon's session on better lending compensation plans for mortgage and commercial lenders. We're going to be doing some speed talking this afternoon because my colleague, Don Hartmann, and I each have about 30 minutes. Don's going to take the mortgage lending piece. I'm going to jump in on the commercial lending piece. We are so just proud, frankly, to be able to tell you that we work with Don. Don was the SVP of compensation for Anheuser-Busch Global, not like he has any experience in compensation, and he's been working with us for a year now, working with us to set your salary ranges, and has done the research here on the mortgage lending piece. So we're really glad to have you, Don. Can't wait to hear what you have to share. So come on up.
Good afternoon, everyone. As Christie said, we're going to talk about the loan officers this afternoon. And because your loan officers are typically some of your most highly commissionable, highly incentive employees in the organization, it's going to be crucial that you make sure that you design these plans correctly, accurately, both for the individual as well as the organization. So we're going to talk a little bit about this today. Okay, so I'm going to start with the MLOs. This should all be pretty customary for everyone. We have two ways that they're going to be typically compensated in their overall total compensation. We have our base pay and our commission. The base pay is typically either broken up into an hourly rate or a salary amount. And then we also have an option of making it a recoverable or non-recoverable draw. Finally, on your commissions, the two most common ways they're paid are monthly and quarterly, but I would say the monthly is probably a little bit more predominant. One key thing to remember as you're paying out these commissions, if you have hourly employees that are paid an hourly rate and they're eligible for overtime during that period, you need to make sure that you're including that commission calculation into that actual overall rate. So something that everybody needs to plan for as you're going on. So there are three main types of incentive plans or commission plans that we're going to see out there in the industry today. The first one is your total dollar plan. Pretty simple. What it's doing is we're just going to take the total dollars that have been funded and closed for the month, and we are going to pay an incentive on that. You typically, yes. Oh, I'm sorry. Better? Okay. I don't like to hear myself talk, so. Okay. So we have three different types of plans that are predominant in the market today. We have the total dollar plan, and that's basically you're going to pay your incentive based upon the total overall dollars that have been funded and closed in that particular period of time. This is most commonly used for your new customers, new members that are going and getting a new product from you. So most times it'll be for the first mortgage. The volume plan is just what it looks like it is. Basically, we're paying on quantity in this case. It's how efficient are we? How many loans can we process through in a given period of time? And that's how we're going to plan the commissions. And then our hybrid plan. And the hybrid plan gives an opportunity for the MLO to do both the total dollar plan as well as the volume plan. Some of the advantages of using it this way is that it gives your MLO an opportunity to pursue all different types of loans. It helps all your different customers and members each feel that they're equal in getting the service that they need. So there's a lot of positives about that hybrid plan. So before you design your incentives, there are many things that you're going to want to be thinking about. There's many different ways to design your plans, but as you're going about that, some of the things that you're going to want to think about is, are you going to differentiate payments between new customers and existing customers? Or I'm going to have one flat amount that's going to be paid across the board regardless of the type of loan it is. What is your MLO compensation philosophy? Do I wish to offer them a higher base with a lower incentive opportunity, or am I going to go with the lower base and use a higher incentive for these individuals? This is the one that most of your high performers prefer because they're not limited in any way. They're going out, they're creating their business for themselves and their portfolio as well as the organization. So quite often, that's the one that they'd prefer if you're given an option. Will your compensation plans allow concessions for new hires? So everybody's got to start somewhere. So when your MLO comes in, and then if they're going to be highly commissionable, how are you going to get them trained without them being concerned about, I'm not making any money? So what you want to do is you want to make sure that you have some kind of guarantee for these individuals as they're learning the process, they're developing their book of business. And then usually, as part of that agreement, you're going to say, okay, we will have a guaranteed amount for some agreed upon part of time. Most common is 90 to 120 days. At that point, then you're going to transition them over to whatever plan is in place for your more experienced MLOs. A couple more that you want to think about. I think, as people were mentioning yesterday, any incentive has to make sense. So when you're designing your incentive program, you need to do some profitability analysis here. It's not going to be good for the organization if you're paying out more than you're actually profiting on these. So you need to understand where I am accumulating those profits, how much I'm going to be willing to share, and come up with some reasonable amount in order to understand how I'm going to pay them that makes the most sense. Then finally, are you going to cap your total commission paid? So some organizations, and it's split in about half, some organizations say, I will pay a maximum dollar amount for any particular one loan. Other organizations say, no, you go out there, the more you earn, the better it's going to be for yourself and what you're earning. So
Let's ask the group. How many people here have a cap on what your mortgage loan officers will make? Two out of everyone. Wow. You want to share what your cap is? You don't have to.
It's on a single loan.
Okay. Oh, it's a cap on a single loan. I see.
Right.
Okay, it's a cap on a single loan. Yeah.
Yeah, and that's primarily what you'll see out there is on any one given loan. So you're not capped on the overall loan amount that you're bringing in, but on any one individual loan. There's a lot of times people will put a limit on the commission that can be earned.
Can I ask another question?
Yes,
How
please.
many people here do the low base, high commission plan? Raise your hand up high. How many still do the, I won't call it high base, it's usually 55 to 60, but high base with a lower commission plan? Raise your hands up high. Okay, it's about what I would have thought. Okay.
Okay. So, as with anything else, a lot of times we want to make sure that our employees are performing. So many groups are putting in some kind of qualifiers to make sure that before we're paying out incentives, that we have quality of that loan. And by that, I mean, is all the documentation complete and accurate? Have all my calculations been made without error? How long is it taking me to fund those particular loans? How efficient am I in my process? Customer satisfaction, okay? It's not going to do us any good if we're cranking all these loans out, but people aren't happy. We want to make sure that we give them the right amount of customer service, member service, so that you develop that sticky relationship. And anytime they want something in the future, they're going to think of you and come back. And then finally, a lot of times you'll have MLOs. So the organization will set certain individual loan goals at the beginning of the year, depending upon what your overall strategy is and where you expect the market to be. And then the individual needs to meet a particular threshold before the incentives kick in. Okay, so best practices. One of the very first things you want to do is implement a formal MLO agreement, and this should be reviewed and signed on an annual basis. How many people in here do that right now? Okay. So one of the key things here is that it has guarantees or protections both for the individual as well as the organization. And by doing it on an annual basis, you can adjust whatever that plan is depending upon if your strategies change, if the market changes, that kind of thing. So you always want to have an MLO agreement in place, and then you should have some kind of language in that agreement that says this plan can be terminated with advance notice. Again, don't ever expect that to happen, but you never know when something like that could come up, so you want that kind of out clause for you. The agreement should have some form of non-compete clause. So for instance, you don't want your very best performers to decide, I'm going to go to another organization and then try and take all your existing loans from their portfolio today, as well as perhaps some of your employees. So you want to make sure that that is spelled out, what you're going to allow and what you might not want to. Unfortunately, there's always kind of disagreements on maybe how things were calculated or what I'm eligible for, or those kinds of things. So you want to include some kind of dispute resolution clause in there. So it's laid out from the front. Everybody understands that if there is a difference, here's the process that we're going to follow to come to an agreement. And then finally, with all of your legal documents, please, please, please have some kind of legal representative review just to make sure all your I's are dotted and your T's are crossed. Okay, some more best practice considerations. You always want to establish that minimal hurdle before any kind of incentives pay out. Usually you're going to have a tiered commission. And what I mean by that is it can be based upon the number of dollars that an MLO brings in at a particular period of time. Or it could be the number of loans that are closed, again, going back to the volume. But what you want to do is you want to make sure that as the MLO makes greater strides and gets to higher loans, either in value or number, that they have an opportunity to earn more for as they do better. So,
Don, well, how many is your normal tier? How many tiers did you see in your research was the norm?
So we saw between 2 and 5 tiers. Typically, we're found in the 2 to 5 range, but most often you'd see the 3 tiers. Okay. And then once you achieve that 3rd tier or that 2nd tier, whatever it may be, that goes all the way back to your first dollars, but they will all be compensated at that higher amount. Whenever possible, you'd like to use an independent party to calculate these incentives. That could be finance or someone in your organization that knows what's been closed, what's come in, what are the values, and how do I apply them to the plan. This is more of an audit consideration so that you have someone independently calculating this, because these are highly paid and compensated individuals. That's one of the things that when an auditor comes in, a lot of times they're going to check right away. So having an independent party do this kind of saves you a little bit on the front side, saying we've already gone through this process and everything's ready to go. If you're not able to do that, then I always believe in the 4I principle. So if the department themselves is going to calculate that incentive, then oftentimes what you're going to want is someone else to look at it. Okay, based upon what the numbers that have been given, are we compensating these people correctly? As you know, errors are very difficult. So if I overpay someone, depending upon what state I'm in, I can't get it back. So having someone else independently verify that is always a good way to help prevent headaches down the road.
I'd like to ask another question. How many people here have a minimum hurdle before they start, or let me ask it differently, how many of you start paying out on the first dollar? Raise your hands high. On the first dollar, you start paying out immediately. And how many would have a minimum hurdle before you start paying out? That's about what I would have expected. Yeah. Okay. Just wanted to check on that.
Perfect. Some additional best practices. You're going to employ that fixed base with a guaranteed minimum. So just like any other employee, there are certain things that are going to be coming out every check. You want to make sure that you have enough income to cover those benefits, to cover those elections and those kinds of things. You want to implement the hybrid approach if possible. And the reasons for this is you're going to reward your MLO for pursuing all the different types of loans. And again, it comes back to a customer satisfaction. Am I doing what I need to do for my member out there? Are they happy with what's happening? And are they going to come back again? incent new customers, new loans with a percentage base calculation, and then those that are existing customers, second mortgages, things like that, more often than not, you're going to have a flat dollar amount.
Is that right? That's interesting.
So what we wanted to do here is there's many different ways to design your plan. So we've talked about a high base, low incentive, low base, high incentive. We talked about hybrid approaches. But what we wanted to do is try and give you an idea based upon asset size, what is the total compensation that these MLOs are going to be? What is the amount that we want to target out there in the industry? And you can see typically those amounts go up as the asset size and the loan portfolios grow. This is not an end-all be-all, but as you're designing your plan, you want to kind of put this in the back of your mind to say, okay, as I'm designing this plan based upon our current goals, here's where I would like my MLO to be at the end of the year.
That's really interesting. Could you go back to that?
Absolutely.
I want to look at these numbers here. Really, so you look here at the 100 to 200, the average compensation is, I know you guys can't see that in the back, that's 82,600. The next one is 89,000. Then we have 107, 102, and then over 5 billion in assets was 142. I would want to add to that is probably indeed the average, but the statistical deviation would be far greater. So you can't just look at the median and say, there's the 50th percentile, there's my answer. The fact is there are a lot that are making more. Do you have MLOs that are making 200,000 a year? Raise your hand. Yeah, not this year, not this year. Do you have MLOs making $300,000 a year? Yeah. And you know what? Because when you look at your average basis points times their production and you can prove exactly what they're netting the company, that's just fine.
Absolutely.
Right? So looking at these average sources, I see a lot of deviation. Looking at this one would make me very suspect. CUNA at an average of 70 doesn't really stand when you look at any of the other sources, but it is considered a reliable source, so it's something to look at, but a little confusing there on how that turned out.
Thank you, Christie.
Yeah, I just wanted to jump in there.
Yeah, so basically these are targets. They're not the end-all be-all, but keep this in the back of your mind. Like I said, it's your little cheat sheet to say, okay, where do I want them to be at the end of the year to make sure that I'm competitive.
Yeah.
Another way to look at this is what is the total cash comp by the loan portfolio or the volume. So you can see again, as your loan portfolio or your volume goes up, your compensation is going to go up. This again is a little bit dated now, but I think it's really good information to know. So for instance, anyone who's averaging a little bit less than $1 million overall in their portfolio, they're not going to make as much as somebody who's on the high end, a $40 to an $80 million person. And again, these are just targets. Quite often they're minimums, but we truly and fully and hope each of these MLOs are going to just blow those out of the water, because that means we're all doing well. Okay, so want to talk about, after I've decided what my strategy is, how can I put some plans together? So I'm going to we'll run through this kind of quickly here, but there's 3 different plans I want to talk about. Each of these plans is going to have the same different kind of assumptions as we're going into them, being the MLO is going to have 4 loans closed per month. They must reach $500,000 a month before becoming commission eligible. And again, these are dollars as an example. Each organization is going to be a little bit different. For some, that 500,000 may be way higher threshold than they want, and others may decide, I don't start that until $1 million. The way I look at that is that's kind of table stakes. I am paying the base wage for the MLO to come in and produce a certain amount. So once that threshold is reached, then they should be incented on top of that. And again, another assumption is the MLO will average $1.5 million closed in loans per month. And then it's also, again, the number will be dependent upon your overall organization strategy and objectives. So this very first one is pretty much, it's 100% commission for our MLO. What we're talking here is that we have given them a $3,000 base to make sure that they have enough to cover all those mandatory deductions. But because it's totally commission-based, we are going to reward these individuals with a little bit higher BIPs on these different loans, because this is how they're going to go out and they're going to make their money on it. So again, once they're commission eligibles, we pay back from the very first dollar. And in our example, the MLO has closed $1.5 million in funded loans for the month. And that's 2 new customers with a total of 800,000, 2 existing with 700. And as you see the calculation goes here, we're going to make 11,500 in commission. But because this is a recoverable draw, we are going to remove the $3,000 from their base, coming to an $8,500 monthly earning, or 102 annual. Here's another plan, excuse me, that's a little bit different. What you're seeing here is the base is going to be guaranteed here. Okay, so we are giving them that base. We're not going to try and recover it, but because they are guaranteed that amount in this calculation, the BIPs that they're going to get for each of those loans is a little bit lower. So same assumptions all the way through, and when we look at our calculations, we're going to have $5,400 earned in your monthly commission. Adding to that your $3,000 monthly base, 84 total, and 100 grand for the year. And then here's the final plan that we want to look at. This is the high base, low commission. So depending upon what your market is, what your organizational strategy is, how mature am I out there in my offerings, how many MLOs do I have, what are the loan portfolio sizes. Those are all things that you're going to want to consider. And in some cases, it's going to make more sense to give everyone a higher base, and the commission opportunity will be less in this case. So on this different loan example, what we're going to have is the flat dollar amounts being paid on all our loans. They have to close 4 in a given month to become eligible. And in this case, the MLO is closed 6 months. 3 of those are new customer, 3 existing customer. So again, doing the calculation, much smaller commission, $2,550, added to the higher base, which is your $6,000, $8,550, and again, we're really at that 100 grand mark for the year. So 3 different ways to achieve the very same thing. So when you're looking out there at your total compensation, as an organization, you need to try and decide, how do I want to best support my individuals and the overall corporate goals? So just to kind of wrap it all up here, out there today, those were just examples to give you how you might design your actual plans. But what we are seeing out there today is that for those that are based on the volume-based commissions, there's a range from some individual organizations are paying $25 all the way up to $750 for a loan. So pretty broad range there. And that can be incremental across the way too, depending upon how you design your plan. But most often your higher incentives are going to be based upon your forced mortgages, new business to the organization, with your lower amounts being paid for ones that are either, they could be internal referrals or an existing customer. The other way to look at it on your dollar-based commission is you're going to see ranges, I found ranges all the way from 10 to 125 bips for those. Most commonly, what we saw is 20 to 60 bips. And again, all these are going to depend, what you end up choosing is going to depend upon your organizational philosophy. How do I want to compensate my people? Do I want to be very aggressive to make sure that I have the best? Or do I want to just make sure, understanding my market today, they don't have the same opportunity, so how do I compensate them fairly? And so you can manipulate your different figures there to get to that point you want. Very, very flexible, but if you have that end marker in sight, then it gives you an idea of how I want to get there.
All right.
That's it for the MLOs.
Good. Thank you. Good job. Thank you. Sir, Spencer.
Just a quick question. So in your example, you had the percentage of payouts based off of new customer versus existing customer. Have you seen credit unions or banks do that differently depending on loan type? So first mortgage versus construction versus,
Yes, great question. Typically, you are going to find that incentive based upon the type of loan. And depending upon, you might be agricultural focused, you might be construction focused. All these different kinds of things are determine your organizational strategy. And then you can decide, how do I want to compensate this? Maybe my focus for this year is I really want to beef up my construction loans. So when you're developing your plan for the year, you might say, okay, I'm going to tweak this calculation a little bit so that at the end of the year, I'm hopeful that I'm going to achieve my overall corporate goals. So many different ways to do it, but it is very flexible. And I really think that tailoring it to your own business is the best route to go.
Thank you. In the last week, I've heard of 2 banks that have divested their whole mortgage department and just decided they'd build it up again once mortgages take up. Does anyone, and others have said that they are finding other places for these people to stay productive within their organization while the market is down. So a lot going on in that industry. All right, I'm going to jump into here. Let's see, I really hate talking like this. I'm glad you're going to get the stocks, but there's some really important information that we need to cover. So certainly concerns about the commercial real estate crash have followed the SVP and the regional banking crisis. Wall Street panicked, stocks of developers and the banks that financed them plummeted. About 25% of office building loans are coming due, and those people are going to be asked to refinance at the 7 to 8% versus the 4 to 5.5% that they've been used to. The good news is everyone is charging those rates, so if you have a good relationship, you'll probably retain that relationship. But that seems to be, with the office vacancy rates that have risen to almost 20%, and I'm sure that varies from market to market, the opportunity for commercial lenders is going to be limited. There's less commercial real estate on the, that people are wanting to borrow for. It'll be kind of redoing some of those loans. However, that said, to date, banks have lost no money on commercial real estate. They're still doing very well with what they have, and without a deep recession, which is highly unlikely, it will probably be a fine market. Also, at the same time, the percentage of small businesses seeking traditional financing fell from 43% in 2019 to 37% in 2020, and then to 34% in 2022 from the Mortgage Bankers Association. So a lot going on in the industry that will affect the opportunity for making a loan, which to a commercial lender is the opportunity for making commission, is definitely down a little bit as well. So most prevalent were individual production plans. So what we did for this project is we asked a lot of our clients if they would share, and they did. It was crazy how wonderful that you all were to share their commercial lender plans and their mortgage lender plans. And then Don researched, what are these plans doing? Because to date, we could always tell you what's the market paying, but we didn't really speak too much on design. That's really beyond the scope of our normal relationship with clients. We wanted to bring you a little bit more information on how those plans are being developed. Quarterly commissions on fees originated and annual commissions on loan productivity minus any penalties is the typical commercial loan officer incentive plan. So I am finding that those that do receive individual that are highly commissionable positions are not eligible typically to participate in the annual corporate, some of you call it profit sharing plans, but the short-term bonus based on corporate results is kind of seen more as double dipping. The same with the MLOs for that matter. So that can vary from organization to, or for those of you, would you raise your hand if your commercial lenders are not allowed to participate in your annual bonus as well? I think you guys like to see what each other are doing, right? Raise your hand up high if they still participate. If they still participate in the annual bonus, yeah. I think there's maybe a little savings there that you could find. depending on if your commission plan is also competitive to market. It's hard to justify maybe that piece. So incentives are paid out on the first dollar. You might consider a loan production level before becoming eligible. There are some penalties like past due loans, mature loans, managing those mature loans within 30 days of the due date. If the loan can they downgrade the loan prior to the loan review finding out that those are some things that you might want to think about in terms of penalties. A favorite of mine, favorite penalties sounds really harsh, doesn't it? Is they have a real reputation for not cleaning up those exceptions and leaving that to I see all of you bobbing your heads, and leaving that to their loan assistants, if you will, leaving that to them. And I think compliance is a very important part of the job, and the job's not done until all those exceptions. When you're making over $100,000 a year, is it okay if we expect you to wrap that job up and get it done right? Can I hear an amen? Yeah, I thought so. I thought I could. All right. So some things you might consider would be, in looking at these plans, I found that if you have a top performer and you want to offer a discretionary bonus for your top performer, that's something that organizations might like to do. Weight your goals according to your organizational strategy, which is going to vary from year to year. I remember going to a conference, and it was a bankers conference, and they were complaining about how commercial lenders don't bring in deposits. And I had to smirk because I thought, I've never seen an incentive plan that actually told them you value that. So of course they didn't bring you any deposits. You didn't tell them it was a priority, other than just, it would be nice if it'd be nice if you brought in some deposits or look for that opportunity. Treasury management products are very important. That is the glue to the relationship, right? ACH, remote capture, commercial fee income, sometimes first year profitability. So these are some of the incentive designs you might want to consider. Some common goals might be new. Of course, you're expecting new gross loan production, but you might look at portfolio growth. You don't want them just to have one big fat loan, one big fat account that they take care of, right? Non-interest income from loan servicing, like fees collected, interest income, net promoter score. And some additional ideas were exception cleanup, residential mortgage referral, deposit account referrals, portfolio servicing. How many of you have an incentive plan that compensates commercial lenders for their portfolio management? Just managing the current account. About 2. Yeah, I would expect that as well. I'm not a fan of it. I think you want them out there. I think one of the threats, the dangers of this job is when you have someone who is a sales professional and they get tied down with non-revenue producing work. I mean, there's still only 40 to 50 hours a week. 40 is all we can really ask for, right? They're not entrepreneurs, are they? So, there's only so many hours in the week, and how do you want them spending their time? I think this is a real danger for you credit union people out there. Can I be square with you on that? Because you typically have 1 or 2 commercial lenders. You probably don't even have commercial or credit analysts. I don't see many that do unless they're really all in. Maybe they think they outsource that risk to their CUSO, and there is such a risk if you don't have someone internally who owns that, right? So when you have 1 or 2 people, so you go out to the market, you compete with a bank, you usually hire a commercial lender 2 or a 3, and a 2 is somebody that can have like a $20 to $50 million portfolio, and a 3 is maybe someone with $50 to $75 million. And then you want them to build your whole infrastructure, your credit analysis, and they don't have time for sales. So it doesn't matter how effective you are at learning commercial lending. They don't have time for new revenue generation. That's something that you might want to really, really consider on the infrastructure to set them free to do what they do best. Because, there's a reason that Dennis Rodman would not make a great coach. great basketball player, but not a great manager, not a great coach, right? And when you look at the profile of a successful commercial lender, that doesn't mean that they're going to be a great manager, infrastructure producer. So those are just some things that I see, and I'm so grateful for this opportunity to tell you that it's always been a fear, it's really a fear and a concern of mine that I don't feel like they understand the exposure at having people on staff that can free them up from the non-revenue producing activity.
So, what about, like, and I'm kind of stretching a little bit, we don't actually have any commercial right at the moment, so we're looking at, we have ag lenders and it's kind of some of them. But they're doing farm visits, do you kind of lump that in the same category as I know you guys in maintenance?
I'm not an expert on the design plan of ag lending. For the purposes of this, I really delved into commercial. I wish we'd had more time because I really delved into SBA, which I added a little bit, but I did not delve into ag lending plans. So I wouldn't be qualified right now to take a look to answer that. Any other questions at this time? All right, let's look at some numbers. And I'm sorry about the glare because I know that this is rough and I so want you to get some stuff out of here, get some good information out of here. I want you to see how consistent, regardless of asset size, the CLO1 average, by the way, the average has an average percentage of base pay of 18% of base. That is the first time I've ever seen that jump from 10%. And I've been looking for 23 years because I hear people say, oh, they get paid such high commissions, but I look in each and every survey, each and every year, and up until this year with a blindfold on, I would have said it's 10%. It's always 10%. It's not 10% anymore. They're getting paid 18%. Look at the consistency on base. 82,000, 82,000, 83,000, 85,000. We're up to $1 billion. It's only 86,000. We're at 2 to 4. We're at 90,000 for a CLO1. One mistake that many of you make is not defining what a CLO1 is, because these are sales professionals and they are really good at negotiating for titles when they come on board. Like, I'd love to work for you, but I'm called a SVP here. You wouldn't want my clients to think that I got a demotion and took a lower job, right? So they come in with a great title. Maybe you didn't go SVP. Maybe you did VP. Whatever you did, whatever you call it, a CLO1 has less than a $20 million loan portfolio, okay? Let's look at the CLO2, an average commission of 22% of base pay, up from 12 to 15. And I'm telling you, for 22 out of the last 23 years, if you called me on any day and asked what is the average, I would have told you 12 to 15%, and I would have proved it with every survey I have. It is up to 22%. And let's look at base. 102,000, 102,000, 104,000, 106,000. We're up to $1 billion. It's only 14,000 higher. And we're up to 2 to 4 billion. We're at 123,000. So you all know that you compete for the same talent. It is not one of those jobs, unlike most of your, well, at least your executive higher level jobs, where salaries go up significantly based on asset size, because you're competing for the same talent. You all want those people that are capable of bringing in serious commercial loan relationships that are long-term. And then looking at a CLO3, I've called it above 50,000, but I would eat my words if you had someone that could do 100 million. You said you had someone doing 200 million? Is that someone here today said they had someone doing 200 million? You don't have to raise your hand. You don't want everyone here calling them. So also about the same percentage of base pay, and that base pay is about $20,000 higher. You do start to see a little bit more variance in the base pay, but at 2 to 4, you know, statistics can't explain where the number, I can't tell you why, I can only tell you what the numbers are. I would venture all of these are right around 140,000, right? So, of course, this base pay has to be factored to your geographical wage differential. If you're in San Jose, you're going to take it times 1.30. If you're in Wichita, Kansas, you're going to take it times 0.94. So don't walk out of here and say BalancedComp said that's what they should make. in compensation, because these numbers aren't right for you. And you will find your commercial loan officer resistant to trying to define the 1, 2, 3, and 4 levels by asset size. I don't care if he's resistant or not. This is the reality, and he needs to. They need to really define that in order so that you can be consistent with how your compensation, because there have been too many projects that we've done where we come on and you have a CLO 2 and they have a larger portfolio size than or you have a commercial lender 2 and they have a larger portfolio size than the VP by a long shot, and they're compensated differently. And you know what happens when you have inconsistent compensation, right? You get all kinds of allocations there. All right. Beware of online surveys that employees view. They do not break out the portfolio size. So yes, they can all go out to www.iaintpaidenough.com, and they will find an amount that is higher than what they're currently paid. They don't factor that by the geographical wage differential, and you don't know what the average portfolio size that would justify that compensation. So those are some things that you might educate them on, right? Okay, any questions about what I've said so far? All right. Okay, some things you need to know. On that fastest moving salary, remember in presentation number 1, fastest moving salaries, the CLOs, the chief lending officer salary moved by 16.25% over the past 2 years. All right. And I don't care if you call it EVP of lending, that is your CLO. Can we all agree on that? Okay, we won't let titles interfere. The CLO 1 salary moved just consistent with the last 2 years at 6.25. Even your commercial loan assistant salary also increased by 11.39. Your credit analyst 2, very hard to find job, increased by 13.53, and even your 1, and who is your 1? Those are people that graduated right out of college with a degree in finance or accounting, and they don't really have any experience. That salary grew by almost 12%. The commercial lending manager was pretty much in line with the market at 7.79%. So these are some things to remember. It's something we've added in our salary survey, which I'm really excited about this year for the first time. It's one thing to open up a book and find a midpoint and to multiply that times your geo. It's another thing to know that midpoint you're looking at just moved 16% over the last 2 years. That's called perspective, and you need that perspective when you're looking at that, right? Yeah, Patty.
For producing managers, does most everybody provide a base pay plus commission on top of that for being a producing manager, or is it still a recoverable draw against their commissions?
No, I don't think I'm not finding recoverable draws for commercial lenders, but I still think the first question was important, the first part of that question here. Are you paying your commercial loan manager for his individual production? Yes or no? Raise your hand. Yes. Pardon? You call them team leaders, and is it on their own production or on their team's production? Okay, a different rate. Yeah. Anyone else? Does that create any competition between the two? And is that a positive or negative? Okay. All right. Good. Thank you for that. Anybody else? Any other questions? Good. Okay. Good. Most credit unions are limited to only 12.25% of their total loan portfolio to be allowed in commercial lending unless you're in a designated low-income area, and then they can have, that's why you're only hiring 1 or 2 people, and you want to hire someone that's competent, but it's often like go big or go home, because if you don't have the infrastructure to support it, it can eat your lunch. Scott, can I ask you if you have what do you think about what I've said? Oh, okay. All right. Okay. All right. Just wanted to make sure. Yeah. All right. Yeah, let's talk about the commercial lender background. It is not someone with a nice suit and a good handshake. It really should be someone that came from a credit analysis background. A few years ago, I kind of saw a trend where you had some organizations that hired the traditional lender who had a credit analysis background and could do the margins and the spreads, and they did that for 2 to 5 years, and then they were promoted into being a commercial lender. And then I saw some that were just hiring business development, just the hunter-gatherers. They really didn't have the experience in credit analysis. I think it represents significant exposure because they are the only boots on the ground, and putting commercial loans together is more than just getting the right documents and having someone else take a look at it. They need to know what they're looking for, or they can get you in a world of hurt. So 2 to 5 year degree in finance or accounting. Also, sometimes they just look for B2B experience if they are going to just to be like a small business banker. A small business banker is typically someone that is like a commercial lender, but their loans are typically under $500,000. Some of you might define it as under $250,000, but they are not doing, maybe once in a while, but they're not doing the big commercial loans. Does anybody here have a small business banking department as well as a commercial lending? And do you have, thank you, 4 of them, and do you have different incentive plans, or is it the same incentive plan but just on smaller loans? Different, same, different? It's in North. Oh, okay, got it. I would like to ask you to consider not having a junior commercial lender row. Would anybody here want to be called junior HR manager? No, please stop that. Every time I see it, I just cringe. It's so insulting. And they're supposed to just be grateful for it because they used to be credit analysts. But you might as well give them a t-shirt that says, "Don't take me at all serious." And it makes it super hard for them to really get their start. So it is simply a commercial lender 1, paid lower in the range due to less experience, okay? Yeah. Oh, I want you to have reasonable expectations. Sometimes you hire these people and you say, "What kind of a portfolio do you have?" And they say, "I have a $50 million portfolio." And you go ahead and give them the pay that they're commanding, expecting that they're going to bring that in. But really, only about 50% of that actualizes over the first 18 months. It's just too hard to make the change. And right now, when many of their clients have a 4.5% interest loan, they're not following that lender for an 8% loan, no matter how much they like the person, right? So this is totally anecdotal, but every CEO I have spoken to or commercial lender that I've spoken to, I always ask that question to get a feel for when you recruit someone, how much of that actually follows them? Because sometimes I feel like you have ordered and paid for the filet and you've gotten a chopped sirloin. So, you're paying big dollars for someone you think is really going to make a difference, and then it never materializes. Have you had that happen? Yeah, that's right. Do not confuse commercial lending comp with SBA comp. Please don't. SBA lenders, since just this last year, they've opened up the licenses for who can do an SBA to even non-financial institutions, okay? So I'm saying that the competition for the SBA lender is growing. They got their first taste on that PPP money, and it's exciting. I mean, they get a lot. They're making 7 and 9% on loans, with 75 to 90% of the loan guaranteed by the government that it won't go belly up. So there's no risk and high fees. And every one of those lender positions are paid. I was honestly a little bit shocked because this is the Help the New Entrepreneur program, right? And I'm looking like every one of them are getting great, amazing commissions. An SBA lender 1 who has a total cash comp of $125,000 has under a $10 million portfolio. Do you remember how much you had to do as a commercial lender one in order to make $125,000? It was about double, right? An SBA lender two, which is between $10 and $15 million, is going to make a total cash comp of $200,000 to $225,000. Is anyone here, is that wow anybody? Wow. An SBA lender 3 is $15 to $25 million, which is only a commercial loan officer 2, and it's the same skill set. It's the same compensable factors in the job. They're just paid very differently. That's total cash comp of $250,000 to $350,000 a year. There are only 2 SBA lending surveys. One of them is the Coleman report, and the other one I can't remember at the moment, but there are only 2 in the nation, and I've looked at both of those. And don't forget your SBA director, the one that's over all that, based on about 175 to 190 base pay with a total cash comp of 250 to 400 million. Yeah, I used to say, I said just today that I would, if I worked for a bank, I'd definitely be a commercial lender. I'm taking that back. I would be an SBA lender because it's the same skill set and the same work hours, but it's such a specialty knowledge that they really are making. So, and this, by the way, I didn't even tell you, this is for like a $70 million program. This isn't for like, no one's writing white papers on this, okay? This is just a normal SBA program. They are paid significantly because of the profit margins that are in there. Anyone surprised? Was I the only one surprised? Okay.
Total cash comp is, you need 1,000, it said million, 250 million, 400 million.
No, did I say that?
It's on the slide.
Okay, all right, I apologize. You're right, I didn't mean they're making 250, oh, it does say million. $1 million. No, that should have been a K. All right. All right. Definitely you want your CLO agreement reviewed and signed annually. You want to make sure your incentive plans are clearly understood and communicated. I think you guys know most of this stuff. You know this stuff. What I do want you to do, so what happens if your commercial loan officer comes in, your new person, and they have a new plan that they want to implement for their commercial loan officers? And that just seems super rich to you. So let me say it a little differently. So what happens if grade 20 or 21 job comes into your grade 17 office and they have a new incentive plan that they want to implement for their commercial lenders, and they are sure that you are paying under market for your people. And by the way, I don't think it ever works the other way. Have you ever had someone come in and say, you're paying these people too much? Do you know that? Like, no one ever said that conversation, did they? They don't, they think, what do you do? What would be your approach? Patty?
I would ask them to stay connected with the CFO on the profitability of that first to see if it actually fits within most of it.
That's very nice. That's a good start. That's great. Anybody else have any advice? Linda, you're dogging the question. You're like, go talk to the CEO. Not mine. Verna said I'd have them prove the profitability of the plan. Okay, that's good. Anyone else?
See, you have to take it to legal.
Pardon me?
Take it to legal.
I'm sure it'll be legal. I'm sure it would be legal. I'm just thinking this through with you because I've given you a lot of good information and I hope that that's all very helpful. But this is where the rubber meets the road and where we really figure out, do we really have a plan on how to handle that? So looking at what the average total cash comp is, okay? Looking at what the average total cash comp and figuring out what is the average portfolio size and then the average margin has to be a good start. I know that with mortgage lending, it's easy to look at your average basis points times what they've historically done, how much are they averagely netting you, and then looking at the average total cash comp and seeing how you can look at that profitability to find something that will be a good fit for both parties. It's something like that with commercial lending as well. It's just a little bit more complex. But I hope with the information I've given you today, you can look at the average total cash comp, take a look at the average portfolio size, so you're looking at your margin. And here's the other thing. I know, does it sound like I'm against paying commercial lenders? I'm really not. Let me say it this way. If someone can carry a $100 million portfolio, just to make math easy, and they have a 4% margin, and they're making your company $4 million a year, forget what the comp consultant said. Keep them. How many people are there who can carry a $100 million portfolio? There's a lot that can do 10. There's a lot that can do 15. So you have to also look at supply and demand of the talent base. And sometimes the question is, what's it worth to your organization? Not just what do the salary surveys book say, right? But I would do all that work and look at all those pieces. And then I believe that the right answer will surface on what's going to be a win for your organization. Don't forget to put in your compensation documents that these plans can change at will with like a 30-day notice, because I always say new information means new decision making. How many of you, since the market has, the economy, inflation, this interest rate market has changed the incentive pay for your MLO or CLO? I can't see that. Oh, okay. How many, you've changed it? And Allison, can you explain how, would you mind sharing how you changed it? Did you go up? Did you go down? What did you do?
Well, we changed it to incorporate deposits.
To what?
To incorporate deposit growth, so we that's well besides just loans.
So that's weighted in there.
So ours is based on, they get a percentage of the origination fee income from the loans, but they have to also meet a deposit target to get paid the full amount of the incentive. So it's a little bit of a weighted approach between loans and deposits, but it's funded by the loan origination fees.
And they're all paid out quarterly, or they're all paid out quarterly? Ever have clawbacks? Anyone have clawbacks? Ever use clawbacks? No, okay. Ever take a piece of it and hold it, like if it's paid out annually, take 20% and hold that back for the next year to make sure none of those loans went south? That's another thing that I've heard. I'm looking at the research. I'm not saying everyone's doing that, but it is something that I've seen them do to protect both. Okay, well, good. Well, I hope today's session was worthwhile. I think that commercial lending and mortgage lending can be very complicated. Where's Tony? There's our word, complicated. There you go, right? And today you heard a CEO talk about pull up a chair to the table, and pulling up a chair to your lending department, to your CLO, and understanding the margins and understanding what makes the engine move, what brings in the income, what's the biggest impact on your ROE and ROA, and then knowing how you could partner with them on that to create incentive plans to help increase that is the way to pull up a chair as a partner. So, all right, so we're going to go, guys, we have Jamie, and I'm sorry, I can't think of her name, McDonald. And I wanted her to name her speech Nightmare on Benefits Boulevard, because she's brilliant. She's forgotten more than I'll ever know about benefits, and she has some stories to tell us. So that one will be at 4 o'clock. All right, thank you.